Hello, everybody, and welcome back. Emerging markets investments have had a difficult time in recent years, both on the equity and fixed income side. What should change in 2024? Today, we talk to Lyubka Dushanova, portfolio strategist for emerging markets debt at State Street Global Investors, who are managing roughly 40 billion US dollar in emerging market debt about this investment category and the outlook for emerging markets debt. A warm welcome, Lyubka.
Thanks very much for having me.
Lyubka, COVID, the war in Ukraine, price explosions, inflation, rising interest rates. The last few years have been full of unexpected events. How has this affected emerging markets in general?
Yes, that's right. The last few years have been very volatile, and emerging markets have been no exception. I think one trend that we have seen impacting particularly emerging market debt is that emerging market debt is a lot more dependent now on the US economy, on the Fed monetary policy. This has really emerged as one of the main drivers of performance for emerging market debt. Of course, in emerging market debt, we have specific idiosyncratic stories that also drive performance. But over the last 3 years, the data-driven Fed has really been one of the main drivers. For example, if we look at the aftermath of the COVID-related sell-off in early 2020, afterwards, the Fed came with a unprecedented quantitative easing, which lifted the markets and risk assets, and emerging market debt also saw very strong returns in the aftermath of that. And more recently, the invasion of Ukraine by Russia. Even though this was a very specific EM event, actually, when we look at performance of emerging markets in 2022, it is the Fed monetary policy that drove the underperformance through the sell-off in US Treasuries and the stronger dollar, both of which are impacting EM debt negatively.
Which emerging market currency classes and countries surprised negatively and positively in 2023, and what were the reasons for this?
I think the main disappointment was China. At the start of 2023, a lot of investors were really expecting that China reopening from zero COVID policy was going to contribute strongly to global growth and to EM growth. And actually, that has been quite underwhelming, and we continue to see quite negative story flow from China. So this has been probably the greatest disappointment over the course of 2023. Amongst the positive surprises is the performance of EM high yield debt. EM high yield spreads were very wide compared to historical averages at the start of the year, and they tightened quite substantially over the course of 2023. I think that was a surprise because most market participants were expecting some sort of US recession in the second half of the year, which would have had negative impact on high yield spreads. They would have widened when the opposite happened. So, and overall, I think the fact that we had double-digit performance in both local and hard currency debt in 2023 was a positive surprise. I think most market participants didn't actually expect that, judging from the flows into the asset class, which were actually negative.
So you already touched China, the elephant in the room. So to what extent have China's disappointing growth expectations and the crisis in the Chinese property market clouded the outlook for emerging markets debt?
I think the impact of China has been more negative in the equity markets rather than in the fixed income markets. In EM local currency debt, China is 10% of the flagship JP Morgan GBIM Global Diversified Index. But even though that's quite a substantial proportion of the index, Chinese debt is a low yield and low volatility. So it hasn't really been the driver of performance for local currency debt last year. In hard currency debt, China is about 3-4% of the index. The index is very diversified. The JP Morgan MBI index has 69 countries there. So really not substantial impact either. I think the main impact of China on emerging market debt is really more indirect through China's impact on global growth and on commodity prices.
With interest rates rising globally, many investors have recently seen no point in taking higher risks. So why should emerging markets debt become more attractive in 2024 again?
That has certainly been the narrative in 2023, and we have heard this from investors very much as well. Why invest in EM debt when we can get 5% from US Treasuries? But this narrative is changing because the higher for longer narrative is changing as well. As we know, the Fed pivoted in late November last year. So we expect that this narrative is going to change. Also, the other thing that investors have to remember is diversification. EM debt, both local and hard currency debt, is shown to be a great diversifier as part of broader portfolios, has shown to have moderate correlation to global rates and global fixed income and global equities. So I think that's one of the important considerations to keep in mind.
Various elections will be held in emerging markets and developing countries in 2024. So how do you assess the resulting risk from an investor viewpoint?
Yes, elections always bring volatility to the markets, but some elections matter more than others. What we have seen over the past decade in emerging markets is that idiosyncratic risk has been quite contained. We haven't seen a huge spillover more broadly to EM debt. I think the election, which is going to probably have the most widespread impact on emerging market debt, is ironically not taking place in emerging markets. It is the US election. And we see a Trump win as more negative for emerging market debt. Last time around, when Trump won the elections, we had negative impact on EM returns. Also, US rates were higher and the dollar was stronger. This time, we don't expect to see a significant sell-off, but we still expect to have initial negative impact if we have a Trump win, at least in the immediate aftermath from the elections.
So when it comes to emerging markets debt, the question always is hard currency or local currency. So how dependent are emerging markets on the US dollar today, and how are you positioning your portfolios in this situation?
We are index investors, so we don't really take currency bets within our portfolios. Mm-hmm. But as you rightly pointed, the dollar is an important driver for emerging markets, and particularly for emerging market local currency debt. If we were to look at what drives performance in emerging market local currency debt, you have the EM rates component and the EMFX component, and EMFX is usually priced versus the dollar. So over the past couple of years, we've had a very strong dollar. The dollar has been really overvalued, not only against EM currencies, but against most global currencies. We think that, the dollar overvaluation will continue to have important impact for EMFX. Now, the dollar has sold off quite substantially in the last quarter of 2023. We think the dollar is on a downward trend, but we believe that there is going to be a substantial volatility and it will trade range bound for probably the most part of 2024. So generally, strong dollar is not good for EM local investors. At the moment, when we look at the valuation of EMFX versus the dollar, EMFX remains highly undervalued versus the dollar. So there is still potential for this to revert to more fair valuation, but it will not happen very quickly. It could take years really for this undervaluation to reverse to more fair value.
The key question driving the market is whether we will see falling interest rates in 2024. So how will central banks in the emerging markets react to any interest rate moves by the Fed and the ECB? And what is your base scenario?
I think it's important to note that in this cycle, EM central banks have actually been ahead of the curve. So EM central banks started hiking their policy rates, in some cases half a year ahead of the Fed. And they were also more aggressive in their hiking cycles. And as a result, really, EM central banks were able to combat inflation much faster than DM central banks. Last year, In 2023, we saw a consistent trend of falling EM inflation, and this really gave EM central banks the ability to start cutting rates in the last quarter of 2023. Now, if we see also the Fed start cutting rates in 2024, which is really what the expectation is, this will give even more ammunition for EM central banks to cut their policy rates even more aggressively. And we think this is very positive for local currency debt, as we'll see local rates continue to rally.
Let's look into the crystal ball for 2024. So which emerging market debt segments and countries are you positive about and why?
Well, we have been more positive on hard currency debt last year, but we have to recognize as well that Q4 of 2023 was exceptionally strong. And we saw a lot of the good things that we were expecting to happen in 2024 already materialize in Q4 of 23. In hard currency debt, we saw EM spreads tighten further. US Treasuries rallied quite substantially and contributed very positively to performance. So we have to recognize that looking into 2024, some of these positive catalysts for hard currency sovereign debt have played out to some extent. And indeed, if we do get some sort of landing of the US economy, even if it's a soft landing, this has potential to drive EM spreads slightly wider. In local currency debt, on the other hand, we think there are still positive catalysts for local currency debt to outperform. As I mentioned, EM rates have the potential to rally further if we see the Fed cutting rates and EM central banks following even more aggressively. Also, as I mentioned earlier, EMFX versus the dollar is still substantially undervalued. And even though we expect the dollar to be volatile over the course of the year, if we could get some positive performance from EMFX versus the dollar as well. So overall, slightly more positive on local currency debt.
So, and eventually a final question. You guys at State Street Global Advisors are specialized on indexed emerging markets investing. So why do you believe a passive approach and passive investing is a superior way of investing in emerging markets debt?
We think that active and passive can definitely work together. But I think what's important for investors to understand is that passive or index approaches, like we call them, are definitely a viable alternative to active management. And the reason for that is there are two main reasons, really. Markets have evolved very much over the past decade. Liquidity in emerging markets has improved. The availability of instruments has improved. So this is making emerging market debt a lot more suitable for index investing. And on the other hand, also investment techniques that sophisticated index managers like State Street use have also evolved very much. We don't have to buy the entire index anymore in order to deliver the index returns. We can just use a sample and do it just investing in a proportion of the index. So the combination of improvement in liquidity, improvement in the structure of emerging markets, combined with improvement in management techniques, is making indexing a viable alternative to active investment in EM debt.
So this was Lyubka Dushanova, portfolio strategist for emerging markets debt at State Street Global Advisors. Thank you very much, Lyubka, for being with us today and sharing your insights on emerging markets.
Thank you for having me.